The Certified Wealth Strategist presents Tactical Strategies Now podcast series. Estate Tax Repeal, Truth or Dare? In the next few minutes, Clark Brown, a performance consultant to top-performing advisors and their firms, will share with you some valuable strategies and information that you can use right now with your clients.
Let me bring you up to speed with some of the things that are going on with the discussions around the estate tax repeal. First, when Congress enacted the Economic Growth and Tax Relief Reconciliation Act of 2001, EGTRA, repealing the estate tax and generation skipping transfer tax for the tax year 2010, and then reinstating those taxes for 2011 and beyond at the 2001 rates and exemption equivalent amounts, many advisors joked that the best advice anyone could offer a client was to die in 2010. But that not-so-funny joke has thoroughly lost its humor with 2010 just around the corner and federal deficits running at an all-time high. The fact is, no one really expects estate and GST taxes to disappear in 2010 or anytime soon, not with wars to fight in Iran and Afghanistan and the economy slogging along here at home. The greatest challenge for advisors and clients is the uncertainty associated with what will happen. There are several proposals out there. Here's a brief summary of what's going on. First, all of the proposals, including the Obama administration's proposal, repeal the repeal of the estate tax and GST tax in 2010. The administration's proposal would simply extend 2009 rates and exemption levels into 2010. The maximum rate for 2009 is 45%, while the applicable exclusion amount for estate and GST taxes is $3.5 million per decedent. In 2011 and beyond, the administration would freeze rates at 45%, and the exclusion amounts for gift, estate, and GST taxes would be unified at $3.5 million and indexed for inflation beginning in 2011. Another proposal would increase the estate tax exemption to $5 million and reduce the maximum estate tax rate to 35% beginning in 2010. Another proposal would make the maximum estate tax rate equal to the capital gains tax rate, currently 20%, for the year 2010 and beyond. Yet other proposals would keep the maximum rate at the current 45% for estates over $1.5 million, but would create surcharges of 5 or 10% for larger estates. Second, not only would all of the proposals continue the estate and GST tax into 2010, they would eliminate step-up basis and replace it instead with carryover basis for assets passing at death. With step-up basis, the assets pass to the heirs with a new cost basis that is determined by the fair market value of the property at the date of death or the alternate valuation date. The effect of a basis step-up is to shelter pre-death appreciation from capital gains taxes when the decedent's property is sold post-death. On the other hand, with carryover basis, the decedent's basis carries over to the estate and the beneficiaries. This means that pre-death appreciation in equities, a closely held business, real estate, would be taxed to the estate or the beneficiaries when the decedent's property is sold. Most clients' wills and trusts already have carryover basis protective provisions regarding the funding of bequests and the selection and sale of assets. However, the actual onset of carryover basis is likely to increase estate liquidity needs, as estates and beneficiaries could feel the sting of both transfer and capital gains taxes at the same time. Look for irrevocable life insurance trusts to become an even more important liquidity resource. Such trusts could serve as private lenders, providing cash to pay estate taxes, administrative costs, and fund bequests without necessitating asset sales. Third, several proposals also include a portability provision that allows surviving spouses with an estate that exceeds the applicable estate tax exemption to apply any unused portion of the deceased spouse's exemption. Under these proposals, however, the deceased spouse's unused exemption would not be indexed for inflation after his or her death. Furthermore, the portability feature would not apply to the GST tax. Portability would eliminate the current use it or lose it approach to the exemption amount that has led to the typical estate plan where, at the death of the first spouse to die, an amount equal to the exemption is left into a bypass trust with the balance then passing to a marital trust. Under the portability provision, even if everything is left to the surviving spouse, either by plan or by default, the surviving spouse could take advantage of the deceased spouse's unused exemption. Fourth, the administration proposes certain reforms to the transfer tax system. One of these relates to discounts for the valuation of family limited partnerships and other similar interests. This is a common planning technique, is designed to impose a significant transfer or withdrawal restriction on those interests. Currently, such restrictions result in valuation discounts for lack of marketability or control of 40% or more. Consequently, when such interests are transferred by gift or bequest, the transfer tax value is much less than it would have been without the discount. The Obama administration's proposal would disallow discounts for many transfers and liquidation restrictions and would require family limited partnerships and other interests to be valued based on assumptions provided by the IRS in future regulations. And no one expects those regulations to result in valuation discounts anywhere near as large as those currently available. Another administration proposal would require minimum terms for grantor retained annuity trusts, or GRATs. GRATs are irrevocable trusts in which the grantor retains an annuity interest for a term of years. The value of the remainder interest for gift tax purposes is the value of the property transferred less the value of the retained interest as measured with reference to the applicable federal regulations. If the annuity payout to the grantor is great enough, the valuation of the remainder interest can be reduced to zero or near zero, allowing the transferred property and post-gift appreciation to pass to the remainderman gift tax-free or nearly so. One drawback to the GRAT is that if the grantor dies during the term of the retained interest, the transferred property is included in his or her estate for estate tax purposes. To minimize the risk of estate inclusion, planners sometimes create rolling GRATs of relatively short duration, for example, say 2 years. These GRATs are designed so that they result in zero or very low gift tax values for the remainder interest. As distributions are received by the grantor from the GRAT, additional short-term GRATs are then created, assuming the grantor's health and life expectancy warrant it. The administration's proposal requires that GRATs last at least 10 years. While this proposal, if enacted, will not eliminate the tax benefits associated with GRATs, it will force planners to consider other strategies for managing the mortality risk. It's a pretty safe bet that estate and GST taxes will remain in place in 2010. It's also a pretty safe bet that transfer taxes will be with us in 2011 and beyond. With federal deficits running high, Congress may be inclined to maintain current levels for rates and exemptions while imposing carryover basis. Carryover basis at death has been a hard sell in the past. Arguments against it have included record-keeping challenges, enforcement difficulties, unfairness due to pre-death appreciation being subject to both estate and capital gains taxes. These arguments carry less weight in a computerized world where record-keeping and enforcement is no harder at death than during life. The fairness issue is weakened if exemption levels are set high enough so that only the very wealthy are affected by the estate taxes. And the very wealthy are the people we serve. And so you're going to have to stay on top of this, but we'll be here to help you. And we'll bring you the updates as the laws are passed so you can help those clients. Thank you.
This podcast was brought to you by the Certified Wealth Strategist. If you missed a previous podcast or would like to learn more about the fastest growing certification in the financial services industry, please visit www.certifiedwealthstrategist.com.